My name is Big Mike Zlotnik, and welcome to Tempo Family. We're all about helping you find great, predictable, reliable, conservative investments in commercial real estate. If this sounds like the kind of a journey you like to take, join our community by subscribing. Let's do this together.
This is Big Mike Zlotnik, and this is a short video with my thoughts on market insights. We're going to talk a little bit about interest rates, the Fed recent cut in September. We are now in October, forward outlook, and then we will also cover a government shutdown, how long it's going to last, the impact, and where we go from here. So we'll start with the Federal Reserve policy and the impact on real estate. So as we all know, the Fed restarted interest rate cuts in September with a quarter-point cut, and now their forward guidance is to cut another 25 basis points, another 0.25% in October, and likely another cut in December. And recent commentary from Jay Powell, he has seen weakness, economic softness, and the October cut is almost locked in. Now, as far as December cut, it is probabilistic. And then from there, of course, the Fed doesn't want to set any expectations other than they're data-driven. So I would say from my point of view, we're locked into 2 rate cuts in the rest of 2025. Now, let's take a look at 2026. So we expect that the policy might remain still a little bit restrictive, tight, to anchor inflation, but flexible enough to support slowing economic growth. And we are beginning to see slowing economic growth. So the Fed Chair Jay Powell has another 5 months in 2026 in the office. His term matures in May 2026. So you'll proceed cautiously. However, it is possible and likely that he will do at least 1 or 2 rate cuts in 2026 in his remaining 5 months. Following Fed chair is likely to be appointed to be a lot more dovish. And it is possible that the new Fed chair will get more aggressive with rate cuts, not only the size, but the frequency. So we can find ourselves, let's call it a year, maybe a year and a quarter from now, with the Fed funds rate cut by another, let's call it 1.5%, maybe even more. So as difficult to believe as it might be, there's a lot of data supporting the need for further cuts. AI investment, as much as it has supported GDP growth, on the other side, the impact on increased productivity and likely white-collar job losses cannot be understated. So AI in general is deflationary in nature. Overall inflation, instead of accelerating, might actually meaningfully decelerate. So again, it's a wait and see. My personal view, as I said, we will find Fed funds rate by the end of 2026, probably at least 1.5% lower where we are today. And on the other side of the spectrum, what happens with the 5 and 10-year Treasury yields, and these drive mortgage rates. So my general view on this is that the market, of course, determines the pricing and the level of interest rate on the bonds, and the substitution effect. Effectively, as the Fed cuts rates, folks who keeping their investments in the short maturity bonds may have no choice but start moving into long maturity bonds. The substitution effect will put downwards pressure on the 5 and 10 and 30-year treasuries. And of course, we don't know where we go from here, but the 10-year treasury yield is generally supposed to be long-term view of where the inflation goes, at least the current view. So I would expect, and these are crystal ball conversations, I could be completely wrong, but I would expect that the 10-year treasury yield will compress further from around 4% right now, and it has actually moved down meaningfully already. It could continue its path down towards 3.5%. So my view of the world, 0.5% lower interest rates on the longer end of the yield curve, on the 10-year treasury yield and corresponding mortgages, as well as Fed cutting their rates. All this is actually very generally positive news for the commercial real estate or real estate in general, because it improves affordability for the housing units. It also improves cash flows and likely might support better valuations for the commercial real estate. So it's tailwind. We're going in that direction. President Trump is a real estate guy in his heart, and we're going to see more of that behind the scenes pressure rather than public pressure until the new Fed chair steps in, and then the new Fed chair is likely to represent significant, even though they're supposed to be independent, but he will likely be looking out for the interest of the president who appointed him. So all that is how I see the forward scenario on the interest rates. And all those things are they're supportive of real estate in general. So let's talk about government shutdown, what it means for real estate. So some of the very basic impact items of what's happening today while the government is in a shutdown. So mortgage and loan delays for closing, FHA, VA, USDA, and related government products. There's some bottlenecks in the system. Also, IRS is not working. So IRS cannot verify incomes. They cannot verify formally filed tax returns. And that's going to slow down not only the mortgages that I mentioned, but even traditional mortgages if a verification is required from the IRS. So we're going to see slower activity. There are also flood insurance gaps. National Flood Insurance Program can issue new policies, freezing transactions in the flood zones. HUD department and support for housing interruptions, rental assistance, and multifamily programs all face delays, impacting affordability projects where there's dependency on government programs. Furthermore, permitting and development could be on pause. Environmental and construction permits tied to federal agencies could stall and wait until the government reopens. Furthermore, some of the local impact could be on the federal workers that are on furlough or just not getting paid. So until the government reopens, a significant number of folks could not see a paycheck. And again, much depends on what politicians will do. But in absence of any action, some negative economic impact on the GDP. So how much of that? There's an estimate that every week we could see a negative 0.1% on GDP. The government plays a pretty significant role in the economy, and the fact that the government is formally closed is going to drag overall GDP down. That's where we find ourselves. Now, here's my theory on economic slowdown and real estate. So as economy slows down, as unemployment rate can pick up, as GDP growth could slow, it'll give more incentive for the Fed to cut interest rates. It's kind of bad news could be good news in hiding. So if you think a little bit about the basics of how it works, economic slowdown may decelerate rent collection, may make things a little bit more difficult for the multifamily sector. But on the other side, if the interest rates come down significantly faster, that will be a lot of tailwind in a manner of speaking. So overall, there's only one level of interest rates. And as economy slows and the rate cuts come in, it's actually a welcome news for the real estate in general. Now, what are we working on today? Where do we see opportunities? In what sectors to invest in real estate? We're very cautious on multifamily because multifamily is still trying to find the bottom of the market. With all the issues, obviously government shutdown is not helping multifamily sector. But what is very attractive today and has long-term growth and predictability are two primary strategies. One, we see industrial. So why we love industrial is because there is US-based manufacturing move. There's a lot of investments, obviously, in infrastructure and AI. US manufacturing and any US-based warehousing continues to pick up momentum. So we love US manufacturing. We love the nature of absolute triple net leases, predictability, long-term tenants. So these fluctuations, slowing economy does not impact these long-term leases because these are long-term tenants with 20, 25-year lease agreements and a very predictable income growth. Typically, a lot of these rents are structured to have annual 2 to 3% rent escalation clause, and all the growth in expenses get passed through to the tenants through the absolute triple net leases. So we love industrial sector. It appears to be one of the most attractive sectors today and for years to come. We also continue to like open air shopping, service oriented, folks still continue to shop. Grocery-centered anchors, they still continue to be very strong demand, long-term leases. These type of necessities and this type of shopping is likely to do just fine during an economic slowdown. And we love service-oriented, all local type of retail, not the shopping malls, but strip plazas and related, especially when they're anchored by a good grocery anchor tenant. Other strategies at the moment are not as clear where we go from here. We've seen pretty healthy rent growths in certain areas, while some other areas of the country have seen some overbuilding in storage or multifamily sectors. We're very cautious in those sectors because it's not clear where the bottom of the market is and what are the right prices for these assets. So from our point of view, we will continue to be opportunistic, but we have significantly focused on strong downside protection, conservative investing strategies, and we love triple net industrial as one of our top sectors for the upcoming quarters and years to come. So thank you, and until the next time.